interest in a boat or a 50% interest in a piece of land with a stranger. It just doesn't happen. So the point being, sure, conceptually, these co-tenants could have each sold their interest on the open market, but there's no buyer for that. There's no demand for them. And that's why they end up coming to a court to partition it, so that it can be dealt with as a whole. So it can either be physically divided or sold as a whole, or one guy taking over the whole thing. Okay? So the fact that you're in a co-ownership situation doesn't mean that you can't sell your interest. There just ordinarily is no market for your 50% interest other than the other guy. Who else wants to buy a piece of property other than your co-tenant? Realistically, no. And that's why the law allows you to partition. Okay? Now, there's another type of co-ownership. The reason we're distinguishing it is because it does not have the right of partition. This is tenancy by the entirety. This is co-ownership between a husband and wife only. And not only is it not partitionable, but it's not severable either. And when I say severable, in our prior example, when I told you you could go out and sell your 50% interest, well, you severed the co-tenancy there by selling your 50% interest. In a tenancy by the entirety, you can't even do that. When husband and wife own a piece of property as tenants by the entirety, the husband can't go out and sell his interest alone. A deed from the husband alone passes no interest. Likewise from the wife. Nothing passes if a tenant by the entirety alone, without the joinder of the spouse, tries to sell their interest. You can own, this is not, don't get this confused with homestead here either. You can own hundreds of different pieces of property as tenants by the entirety. It has nothing to do with whether you live there or not, nothing to do with homestead. This is just a type of co-ownership of property between husband and wife only. The way this stuff came about, and this strange tenancy by the entirety, was a presumption under the old common law that the marriage was one thing as opposed to two persons. Upon marriage it becomes one, and that one entity, the marriage, owns this piece of property, and therefore only the two parties together can sell it or mortgage it. They can't separate out the interests. They can't partition out the interests like you can in the other types of co-ownership. There's another very important distinction in tenancy by entirety, but we're going to talk about that in 2 seconds when we get into the chart. I do want us now to go through that chart, that ownership chart. I'd like to break for 2 minutes before we do though, and then we'll come back and pull out that ownership chart and run through it.
Cut her hair. She cut
really?
It really short. It threw me off at first. Like I didn't realize it was her. Yeah.
Awesome.
Yeah. But
she's just a full-time paid employee.
Yeah, full-time paid employee in JLL. Yeah. We went to like a market research meeting.
Oh, cool.
Like all the brokers just get together. The people that own the brokers that do the A-class buildings in downtown. They meet like once a quarter to discuss the transactions and stuff.
Cool.
It was cool. She was like, the WhatsApp group has been so quiet. Yeah, I tried to check in. Like. There's only 6 of us right now.
Yeah, exactly. Nobody's doing anything.
Yeah, in that construction class. How you doing in that?
I made it through the structures, lectures.
Yeah,
Put it on like 2 times speed, and
I'm doing 1.25 and just.
you can up it. 1.75.
She reminded me of that. I did the first 2 weeks like at normal
Like
speed.
real time.
Yeah, real time.
Oh.
And I would stay after work, and just I was just like, yeah. Like I do it in the conference room, and people walk by like that guy looks so annoying. Like I hear his voice, I'm like, you don't want to hear his voice.
I know. But you know, like 1.75 is a good one. You don't miss anything.
Yeah, and I put captions on too, so I can read.
Oh really?
Yeah. But
Yeah.
I'm not looking forward to that. I heard his tests are just
Brutal.
yeah. Alyssa was like she studied more for that than most classes.
Really?
Because he goes so in depth. Even Dusty was saying like I'm a contractor, like it was just really in depth, which is like okay.
I guess we're learning how to build a skyscraper.
It's gonna really come in useful.
Yeah. Yeah, it'll be an interesting class. The hard part is just finding time to go through those things.
I know.
Good for you for just saying, hey, I'm staying late.
It's like I know that if it takes me like 40 minutes to get home, by the time I get home from work, I'm not gonna do a single thing. Like I can't.
Yeah.
Like I just try and knock it out like an hour.
Yep.
And just plus the traffic subdues so it balances out. Like I was behind until this week. Like I sat all 3 days after work this week just to catch up because I totally forgot about it over the holiday weekend.
Yeah.
But yeah, this class is not too bad.
He scoops out all these notes and has next to no engagement, and you like blah blah blah. You ask a question, so what? I'm gonna pretend I didn't hear that. You're not allowed to ask questions in this class, man. Why? I have a question. Blah 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 blah. I didn't ask a question.
You tried to, you just
tried
kept
to.
going.
Yeah, shut down.
Worse than the girl at a bar that he just
Yeah.
looked at it.
Then I realized I was like, I really don't care about that.
Yeah.
Whatever.
Yeah.
I was more busy. I was like doing a dinner tonight for a birthday here in town. I was like, no, I probably should make a reservation. That's all right.
Or whatever.
Yeah.
Yeah.
Los Olos.
Nice.
You guys are obviously invited. I'm sure you guys don't want to drive.
No, I don't know. I live on Los Olos right now.
Do you really?
No, I work at
You're
Styles,
right,
but
yeah.
I'm there Monday through Friday from God.
Yeah. Good. Far away. I don't know how you do the coconut drive. Coconut drive.
It's not bad in the morning. So the
Awful,
first time
it's
all
awful.
no, the morning's not bad. Maybe like at 7:30, it's not that bad. I put on
Awful.
book on tape, I knocked it out, but it took me
Don't
2
even
hours.
try
Book on tape.
It took me 2 hours to get to
He's
work
driving
on,
from
I think
Los Olos
Thursday it
every
was,
day
because
of the week.
all of 95 northbound
And then
was
coming
shut
down
down
Saturday.
for 8 hours. They were letting no one through.
Whoa.
There was an accident, somebody died and stuff, like right at
So they
the
gotta shut it
yeah.
down.
So I got off to take the turnpike, just
Coming
just so I can go, just to get there on some sort of time.
When he's going
Turnpike
home.
is that bumper to bumper right next to the Dolphin
Gotta go
Stadium.
back home.
Yeah.
So I get off of that and I have to take Ives Dairy, cut back to 95, and I'm sitting on top of 95, and you can see northbound, and not a single car is coming through.
Hope you got a hybrid, man, 'cause that's a lot of miles you're burning there.
No, I have my Santa Fe. I get like 25 miles a gallon. Cruise control in the morning, just book on tape. I'm there in 45 minutes.
Mhm.
Get it, man. It ain't worth it. Quality of life. I
Well,
mean,
life
it
is
is worth
great.
it.
No,
It is.
stop. Working at Styles is a blast. Those people are hilarious. They're animals. Like they are so funny in there. And they own YOLO. Styles owns.
Oh, does it
They
really?
own YOLO. So I went down with Ken Styles, the next CEO.
That's why they're always going down there.
Yeah, so we go to the bar and he goes, what do you want? I'm like, all right, I'll take a beer. And he signs this piece of paper. I'm like, what is that? He goes, oh, we own it, so we have an account here. And he says like 4 times a week, yeah, and like,
Jesus.
yeah, like they love him there too. Like if
Yeah.
they want to get a table and it's filled, like they'll pull one out of the back right now.
Oh,
Like,
he's owning.
Yeah.
he's becoming this next
Hold on.
CEO.
Tendency. No, I'm kidding.
He's becoming the next CEO. I think 2 years they announced it. Terry's gonna step down.
Nice.
Of the board chairman.
Ready to retire.
Yeah, I think it's 2017 or something.
Is he already on the board?
Yeah. Oh yeah. Ken, his son.
Have we met him?
No, I have, but
No, that day we went to that, no.
no, he wasn't there. No. John, not Terry, the other guy, like, goes to him.
Oh, yeah.
He knows who I am, but it's just a ghost.
Oh, yeah. Yeah, I don't have time for you.
He's on the same floor as I am. I work at the same floor as development.
Cool.
Yeah.
So you said you were on acquisition?
No, I'm on the retail and development side. I'm never working on Publix.
It's good, man.
It's fun. It's a lot of work though. I live on the property appraisement CoStar. And I haven't gotten access to the school yet for CoStar. I just use the
No, neither have I.
I just use the work
It's pretty
one.
awesome. I'm like, okay. We'll be right. Yeah. That's a long one. All the time.
Yeah,
I think it's
I'm
fun.
sure, right, of course it's going to be on a little bit.
Yeah, everyone's
Okay, one thing I forgot to mention, tenancy by the entirety. It's terminated by divorce. Tenancy by the entirety, of course, has a right of survivorship. We talked about that. It's tenancy between husband and wife only with a right of survivorship. Tenancy by the entirety is terminated by a divorce decree, and automatically, by law, by Florida statute, the parties become tenants in common upon the entry of a decree. And that's, of course, the legislature has decided that if you didn't want to be married anymore, you probably don't want the right of survivorship with a spouse either.
I might want the opposite.
And then, of course, then the parties can partition. Then, as tenants in common, they can do a partition action to divide up the ownership. Okay, let's take a look at that chart. The chart, of course, it was figure 5.1 of the text that I sent you and asked you to bring in a copy if you would. I'd like us to write a bunch of stuff on here, make notes of what I think are important additional concepts that relate to these types of entities. Everybody have a copy in front of you? Okay, the first thing I'd like you to do is, we skipped the tenancy in partnership, which is the right-hand column, because that does not exist in Florida. No such thing. So kill that column completely. We're not going to discuss tenancy in partnership. We're not going to learn about it. There's some stuff in the text about it. I don't know what it is. Never heard of it, never seen it. We don't have it. The other thing I want you to eliminate, on the left side of the existing headings, subject to dower rights. You remember we talked about there's no dower in Florida. So we don't care whether these tenancies are subject to dower rights. So what we're going to do is talk about the joint tenancy, the tenancy in common, and the tenancy by the entirety, the headings on the three columns. And we're going to talk about the different aspects of them and how are they the same and how do they differ. And going down, we're going to add a bunch more columns, which I'll tell you as we come to. But let's talk through what's there. Survivorship. I think we know. Joint tenancy. Go ahead and add this to your column right now if you would, which I forgot to do. WROS. I want you to always think of joint tenancy as joint tenancy, WROS, at the top of that column. And that pretty well tells you whether or not there's survivorship, right? Yes in a joint tenancy. No in tenancy in common. Yes in tenancy by the entirety. Right of survivorship. One spouse dies, the other one owns it automatically, doesn't go through probate, doesn't go through an estate, nothing to do, no title transfer, no nothing. The surviving owner owns it 100%. Okay. Equal right to possession. That's what we talked about, that legal fiction of are you each, since you're undivided owners, are you each entitled to possession, theoretically, of the whole thing? And the answer is yes. in all cases. You own undivided interest, which means you each own a percentage interest in the whole, and therefore you have equal right to possession. Now remember also, as we talk these concepts through, with the first two, joint tenants right of survivorship or tenancy in common, we could be talking about 10 people. We could be talking about 20. Tenancy by the entirety, obviously we're talking about 2 people. Okay. Can this husband and wife only? That's pretty clear. Joint tenancy right of survivorship and tenancy in common. You can own property as joint tenants or right of survivorship or as tenants in common with your spouse. You can, but the only one that is limited to husband and wives only is tenancy by the entirety. You will find some spouses holding title to property as tenants in common because they have different estate plans, they have prior marriages and prior kids, and they want their stuff to go to the kids separately and not to the other spouse. This happens a lot, where husband and wife are going to own the property together, but not with right of survivorship, and therefore not as tenants by the entirety. Okay. Is the co-ownership severable by one co-owner? Meaning, if somebody deeds their interest, will it end the co-ownership? Well, in the first two, yes, because it certainly ends the ownership between A and B if A conveys to C. Then we got ownership between B and C. What you do need to know is that also kills the survivorship, and we didn't talk about that before. In the joint tenants with right of survivorship, if we have A and B as joint tenants with right of survivorship, and A sells to C, we now have B and C as owners, right? Survivorship's gone.
When there's 3.
They own as tenants in common.
When there's more than 2, is that what you're
I'm
saying?
sorry?
Are you saying when there's more than, when there's 3 and 1 now? Oh, there's more than
If
2?
doesn't matter how many joint tenants with right of survivorship you have, okay? Whether you have 2 or 10. If any one joint tenant with right of survivorship conveys to another party, that kills the survivorship as to everybody. That destroys the survivorship. Okay? In tenants in common, well, yes, you can convey, of course, to somebody else. There was no survivorship to kill anyway. In tenants by the entirety, no. This is what we talked about earlier. A deed or conveyance by one spouse to a third party does not sever the tenancy. It does not kill the survivorship because it accomplishes nothing. One spouse cannot convey, period. All right, we've killed the dower rights column, but let's add some more columns here. Going down the left-hand side, I'd like you to add some more columns of things that I think are important attributes of these types of tenancies, and we'll add our yes, no, yeses, or whatever as we go under them. The next one, under subject to dower rights, I'd like you to add, can it be partitioned? And Alex, what's the answer to that?
Joint tenancy is yes.
Pardon me?
Joint tenancy is yes.
Joint tenancy with right of survivorship? Yes, it can be partitioned. Tenancy in common?
Yes.
You're right, yes. Tenancy by the entirety, can that be partitioned?
No.
Okay, those are the answers. Yes, yes, and no. Okay. Next column. Can one person, one co-tenant, sell or mortgage his interest? Chad, what do you think these are? For the joint tenants or survivorship, yes or no, can one person sell or mortgage?
No.
No, the answer is yes. Yes, you can, sure can. Tenant in common?
Yeah.
Yes? You bet?
No.
Tenant by the entirety? No, that's for sure. Okay, another one. Can one co-tenant devise his interest in his will? We've got A and B as co-owners. Can A put in his will what's going to happen to his interest? Andre, what do you think? Yes or no?
Joint tenancy, yes.
No, the answer is no, and here's why. Upon his death, it passes automatically to B. If A dies, A doesn't get to say what happens to his interest when he's dead. By law, it passed to B. So, one co-tenant in a joint tenancy with a right of survivorship cannot will his interest. No. How about in a tenancy in common?
Yes.
That is yes. Clearly he can. How about a tenancy by the entirety?
Couldn't you get around that by just selling to, because you can sell your interest, so couldn't you get around that by just selling it to your somebody else for $1?
Well, no, we're talking about will. We're saying in your will. We're saying in your will. Can you will your property?
Okay.
You mean sell something in your will? I'm not following you.
Yeah, I guess it wouldn't work that way.
What we're saying is, if I own property in common with you in one of these different ways, does my will control what happens to it on my death? That's what the concept is here. Does my will decide what's going to happen when I die or not? The first case with right of survivorship, of course not. My will has nothing to say about it. It's already been decided it's going to pass. Tenants in common, yes. We talked about tenants in common. If we talked about in our example earlier, if Alex and I owned it as tenants in common, you'd want your interest to be able to pass to your family. I'd want my interest to be able to pass to my family. So we could will it. How about in a tenancy by the entirety, though, between husband and wife? No. No, clearly no. Because it has right of survivorship. If you have right of survivorship, your will has nothing to say about it. Your estate has nothing to say about it. It's already been determined as a matter of law what's going to happen. Now here's a huge one we haven't talked about. A judgment or a lien against one of the co-tenants. Will it attach to their interest? If Alex and I own a piece of property together, and somebody gets $1 million judgment against just me, can they take my interest in the property? Yes. Joint tenants and right of survivorship? Yes.
Just your interest, not my interest.
Exactly. They can't take your property. They can take my 50% interest, okay? You got a new partner, and there's no more survivorship.
And then do I have to, I guess, come to terms with that new partner? Or, like, so for instance, they take your own, your 50%, I don't have a say in that.
Absolutely not.
So, well, usually does that happen? I guess the company should probably dissolve or buy someone else out unless they agree on terms.
Well, remember what we talked about was that this is if somebody has a judgment against me.
Okay,
This is,
yeah.
I didn't sell it to them.
Okay, yeah.
I borrowed money from a bank.
Mm-hmm.
I didn't pay them back. Bank sued me and got a judgment. takes my interest in the property that I own jointly with you. Okay? They take away my interest. You got a new partner, you got a new co-owner, okay? This right of survivorship is gone because that severed the right of survivorship. You don't want to be survivors with a bank anyway,
No,
okay? And what's probably going to happen?
it's probably be partition or something.
Exactly. One or the other of you is going to partition. You're going to say, I don't want to be partners with a bank. Your Honor, sell it. Or the bank, even more so, is going to say, I don't want to be partners with you. I want some money. The whole reason we did this, the bank did this, was to get some money.
Yeah.
So they'll tell a judge to sell it.
So either way, the partner still gets, unscrewed over, but it's not.
Say that again, please.
So in that case, the partner that didn't do anything wrong, didn't have the judgment, was still,
Judgment does not affect his ownership interest.
of course, but if he has to sell the property, that's not maybe what he wanted to do to begin with.
He is greatly affected by what happened, but his interest is not subject to the judgment, is not claimed. Okay. Now, in the same situation, that's what if we were joint tenants or survivorship. If we were tenants in common, same thing. Judgment against me, creditor takes my interest, you got a new co-tenant, your tenant's in common with somebody else. Whether it's another individual, whether it's a bank, whether it's an individual that I heard who got a PI judgment against me, and then you got a new individual in there, or a bank that I didn't pay and has a claim against me with a judgment, they take my interest. Now what about if you and I are husband and wife, and they get a judgment against just me?
They can't go after the no.
I mean, they're a unit, there's
What if
only,
the
they
property
are
could be
one.
homesteaded?
This is not homestead, I'm not talking about homestead.
Okay, it's not-
Forget homestead, no. This is commercial property we're talking
I'll
about.
say yes.
Then yes, it's commercial property, yes.
No, the answer is no.
No?
And here's why. That's what is so unique about a tenancy by the entirety. A judgment creditor of one spouse cannot attach entirety's property. The reason is that old legal fiction we talked about. When the parties are married, they become one, and there is really only one owner of that property, and the one owner is the marriage, and the judgment was not against the marriage, it was against one of the spouses. Think this through then. How incredibly, what incredible asset protection this gives a spouse against debts. This is why Florida is called a debtor's haven. This is the second reason. The first reason we talked about an hour ago, homestead. The first reason is you can own a $10 million homestead in Florida and it's not subject to creditors' claims. Second is you can own $100 million worth of property with your spouse jointly as a tenant by the entirety. That's not subject to creditors' claims either. A creditor of just one spouse. Obviously, if husband and wife both had the judgment entered against them, if they both signed a note to the bank, if the bank got a judgment against both, well then of course it can take the property that they own together. That's why tenancy by the entirety is so huge in Florida. The material said that about half of the states have it now. I'm shocked if it's that high. It used to be only 3 or 4, and it's been increasing and increasing and increasing. And that's what makes a tenancy by the entirety, in my mind, very unique. Professionals in a business like me, a doctor, a lawyer, an accountant, who can be sued, can own all of their assets in tenancy by the entirety with their wife. And the creditor who gets the judgment is not going to get it against the wife. She wasn't practicing medicine. She's only going to get a judgment against the doctor. Now, most doctors I know put all of their property in their wife's name. But that's a little scary if their marriage goes to hell. But they can own it jointly with their wife, and it can be just as exempt. Basically, you can be judgment proof. Hey, you might have a car in your name or something, you know, or a bank account in your name. But the big assets, you can own millions of dollars worth of commercial real estate jointly with your spouse. And it's not subject to the claims of creditors against one spouse. Okay. One more column to see how these things come about. How do you create one of these things? How do you create a joint tenancy, a tenancy in common, or a tenancy by the entirety? I want to tell you how you do it so you'll know them when you see them. If you see a deed to A and B as joint tenants with the right of survivorship and not as tenants in common, well, it's pretty damn clear you got a joint tenancy with right of survivorship, right? That's how you created a joint tenancy with right of survivorship. You convey property to A and B, or A, B, C, and D, or F, G, H, however many there are, as joint tenants with right of survivorship and not as tenants in common. You got a joint tenancy with right of survivorship. To convey to parties as tenants in common, you don't have to say anything. Because, as you know, Florida has a presumption that any conveyance to two or more parties creates a tenancy in common unless a contrary intent is evidenced. So a simple conveyance to A and B creates a tenancy in common. You could say it's tenants in common if you want to, but you don't have to. A tenancy by the entirety is a conveyance, a deed, to A and B, comma, his wife, or A and B, comma, her husband, or A and B, husband and wife. Now let me tell you, there's one more presumption in Florida law, but you really don't want to rely on this. There is a presumption in Florida law that any conveyance to husband and wife that doesn't indicate a contrary intent creates a tenancy by the entirety. But you don't want to rely on it because this tenancy by the entirety judgment creditor protection thing is so big and so important that you say it. You make it very clear that ownership is tenancy by the entirety. Because that'll stop creditors dead in their tracks. Now, of course, the moment a divorce decree is entered, boom, those judgments all attach. The moment a divorce decree is entered, they become tenants in common. And then the judgment creditors' judgments against just me attach. We're tenants in common. Okay?
That's why divorces are so.
I'm sorry?
That's why divorces are so complicated. Because it's separated.
Yeah, okay. And, but you'll find that some spouses don't want to be tenants by the entirety because they don't want survivorship. And in which case they'll have tenancy in common. Okay, that's the end of what I wanted to add to the chart. I want you to remember that all this stuff can apply to personal property too. Cars, boats, airplanes, stock certificates, bank accounts. And I want you to think about one concept that's going to lead us to what we're going to do in just a few minutes. If you're going to own property, investment property, we're not talking about your home anymore, commercial property, investment property. If you're going to own property with a bunch of other guys, a bunch of other investors, a bunch of other folks, 4 or 5 of us are going to get together and own a piece of property. If we put title in our individual names, probably as tenants in common, because in an investment situation, we're not going to want the right of survivorship. Think about all the things that can go wrong if you hold title individually. let's say you hold title 5 people, 5 individuals, 6, all 6 of you all together, decide to buy a piece of property together. And you take title in your 6 individual names as tenants in common. Okay? A, B, C, D, E, F. All 6 of us own a piece of property together. Think about all the problems that can happen if you get a divorce and your wife comes after. If you don't pay a bank and they sue you on a judgment. If you file bankruptcy. If somebody gets a $1 million judgment against you and attaches, a personal injury judgment. Even worse, what if you die and the property's tied up in your estate and all your heirs are fighting over the piece of property and the other 5 of us are out here wanting to sell the property and we can't sell because your interest is all screwed up in your estate. There are lots of things that can go wrong by owning commercial property individually. And you're going to see shortly in this chapter why we usually don't do that. It's doable, it's possible, and it happens. And all these bad things that I just talked about happen. All these bad things happen to people anyway. But the question is, do you want them as title holders? Or do you want them maybe just as stockholders in a corporation? That's the kind of concept we're going to shift to. Yes, ma'am.
That's what I was gonna say, then you, instead of doing person or
We're going to talk,
individual.
yeah. I'm trying to set up here the mindset of these things can happen if we own them in these individual ways. Let's see some good reasons to do otherwise. Okay, now, I want to go back to one concept for 2 seconds on the prior page that I just want you to be aware of these buzzwords, but we don't use them in Florida. But you'll hear about it. It's the concept of community property. Forgive me, we're talking about spouses here. We talked, tenancy by the entirety we talked about is Florida's way of having property held between spouses. Other states have a concept called community property for rights between spouses. And all the community property means, well, it's big, is that all assets acquired during the marriage based on the work efforts of either of the partners in the marriage are owned together as community property, no matter how they're titled.
Did you say based on what? You said based on?
Based on.
Okay, the assets acquired during marriage based on,
Based upon the work efforts, I'm sorry,
okay.
based upon the work product or work efforts of either spouse are owned as community property by both spouses. Okay. Here's where that's big, and here's where you hear about it. You hear about it in California and Texas, the big money divorces with the actors with the big bucks. And
Their money is, they make more money than the spouse.
all the money made by an actor during his career is community property in California with his spouse, even if he titled all the assets in his own name alone. So it's a nightmare in a divorce situation for the spouse that has earned all the assets. Spouse has made all the money. And then there are exceptions to that called separate property in those states. I don't want to get into all that stuff because candidly, this stuff is all kind of about divorce law and about ownership law between husband and wives in states other than Florida. It's there in your book, but I don't want to spend any more time on it. I just want you to be familiar with the concept of community property. There is such a thing, but we don't have it in Florida. Now,
Does that apply to personal property as well, or just community?
oh, absolutely. Personal property, real property, everything. Yeah.
What if you had, say, a retirement account?
And a
that
what?
you can, a retirement account that you can prove your spouse never paid into? Doesn't matter?
Retirement accounts, I don't know, frankly,
Okay.
because I don't know that much about community property because we
Right.
don't have it here in Florida.
Oh, we do not have it?
No, we absolutely do not have
Okay.
community property in Florida. That's why I said we're not going to waste much time talking
Yeah.
about this. The text talked a lot about it. California and Texas are the two big states that have it. Florida does not have it.
Yeah.
Retirement accounts are normally not attached in a divorce proceeding. But in community property states, I just don't know. I don't know whether the law changes there, because you see, retirement accounts are more a creature of federal law and not the state law based on community property versus state divorce law. Okay, now, we're going to shift gear a bit here. Although we're going to stop talking about 2 or 3 or 4 or 10 people holding title together individually as individuals, like we just talked about, and all the nightmares that can create. And we're going to talk about how do people own things together, but not in their individual name. Now, the book calls this real estate syndicates. I've never heard or seen that term anywhere other than this book in my life.
It was on our investments book, financial
Okay,
real
well,
estate.
no,
They talk about it too.
I believe it, and probably some places in the country, that's a big deal.
Oh, okay.
My point is, in Florida, you just don't use the term, or real estate syndicate. But what the book calls a real estate syndicate is what I call a bunch of people investing in property together.
Is that an official term?
You know, and it's, the book describes it as a group of investors who combine funds and managerial resources to develop, manage, purchase real estate for profit or as a tax shelter. Okay, well that's cute. That's the buzzword of all this stuff. What I call this is really, how do we want to take title to our piece of property? How do we want to organize ourselves as co-owners? We've all decided we're going to buy a piece of property together. And we've listened to the rantings of the lawyer of all the reasons why you shouldn't own title individually. Death, divorce, bankruptcy, creditors, tax liens, all these bad things. So we need to decide if we're going to own property together. How do we want to take title to the property? And how do we want to organize and govern our relationship as between ourselves? In what form? Now, I'm going to zip through these things real quickly and talk about them as the book talks about them. But then we're going to go over to our chart and talk about them a little more in depth. The simplest, easiest way, the materials start out to say, to own property together is tenancy in common. Yeah, all right, well, that's cool. We've already talked about that, decided there are lots of reasons not to do that. Now, the first choice would be a corporation. We could have a corporation. Corporations have stockholders. Stockholders have limited liability. But there's some downsides to a corporation. Double taxation, the materials talked about. We'll go through that more in depth in a minute. We can have a special type of corporation called an S corporation. Now, S corporation is a corporation just like any other corporation, but it has special tax treatment by the IRS, where it gets taxed like a partnership. So it solves the problem of double taxation, but there are a bunch of limitations on being an S corp. So it doesn't necessarily fit everybody's mold. We can be a partnership. When we say a partnership, we mean a general partnership. A general partnership is 2 or more persons organized to run a business, divide the profits. There are lots of downsides to being a general partnership. It gets wonderful tax treatment, but there are a bunch of liability exposures that we'll talk about in a minute that make it a bad idea.
Consider partnership?
General partnerships.
General partnership.
We could also be a limited partnership. A limited partnership has the benefits of being taxed like a partnership, but not the liability problems. It has limited liability. We could be a joint venture. And a joint venture you're not going to hear about very often other than as a kind of a buzzword, because a joint venture is not really a type of legal entity. A joint venture is a partnership for one deal only. When you form a general partnership, usually it means we're going to do a lot of deals together and be general partners and we'll be partners and all this stuff. If you form it for one project only, a general partnership intended for one single project alone is called a joint venture.
Does it have to be a general partnership?
I'm sorry?
Does a joint venture necessarily have to be a joint partnership, or can it be a limited partnership?
No, it would be a general partnership.
Or, I'm sorry, general partnership.
General partnership only. All right. We could also be what's called an LLC. And as you're going to find out, that's what most people want to be today, is a limited liability company. Now that's a entity that looks a lot like a corporation, has limited liability, but it gets taxed like a partnership. And it's today's darling as an investment vehicle that everybody's using.
Did you say it gets taxed like a corporation?
It functions like a corporation, but it's taxed like a partnership,
Like a partnership.
which is beneficial. Remember, corporate taxation is a negative thing. Partnership taxation is a good thing. So, yes, sir.
Yeah, so in the LLC, it says tax only ones and the income is passed through and is reported on the individual's owner, personal tax return.
That's the same as a partnership.
Is there a percentage difference from the percentage in the tax amount that is charged?
Well, we're gonna talk about taxes in a moment, but I'm gonna say to you, this is not a course on taxes. And we're gonna talk about the ways that entities are taxed, but we're not gonna talk about tax rates at all, because this is not a tax class, nor am I a tax practitioner. But to answer your question in general, in all of these cases where we say the income is passed through to the owners and taxed on their own return, well, that means it's taxed at their own individual rate. Donald Trump's rate may be 40%. My rate may be 10%. We can all, the point is, do you follow what I'm saying? The profits of the partnership or the profits of the LLC are not taxed at the entity level.
No.
They're passed through to the individual owners, and each taxed at his own individual tax level. Does that make sense? We each have a different tax level. I imagine you and I are in different tax brackets. Right? Probably. I don't know, maybe we're in the same. Point is, there are different tax brackets. There's a 10% bracket, a 20%, a 20, 35, a 40. They don't go much over high 30s now.
Okay.
There was a time when there was a 90% tax bracket. But the point is, each person on his own individual return has his own tax bracket. And that's how these profits are taxed, notwithstanding whether they came from a partnership or from an LLC or from a limited partnership. When it says the profits are passed through the individuals and reported on their own returns, they are then taxed like all other income of that individual. You're shaking your head. I don't know how else to say that.
No, I got it.
You got it? Okay, all right. Okay, now, let's go over the chart for a minute and get a little more specific on these things, because we were just talking about these entities in general. And then we're going to come back and talk about one more that we use in Florida that just didn't happen to be on the chart, which is a trust. But let's go over this chart that I asked you to print. And this one, of course, turns sideways the other way. And we're going to talk about the different types of entities going down the left-hand side, and we're gonna talk about their different attributes in columns going across the top. And once again, I'm gonna have you add some more columns to have a better understanding of how these things work. And I'm gonna say this now because I may forget to say it later. But I want you to keep in the back of your head that as to all these different type of entities that we talk about, corporations, partnerships, LLCs, limited partnerships, it may all involve just one person. The whole concept here is, how do we all get together and together buy a piece of property? What would be the best way for the 6 of y'all to organize yourselves, and how should you hold title to a piece of property? But one person can be a corporation. One person can be a limited partnership. One person can be an LLC. Because of the different benefits of these types of entities, sometimes individual investors want to be that type of entity too. It all sounds like real estate syndicate, how do we all get together and group ourselves and invest together? But all these, you can have a one-person corporation, you can't have a one-person partnership. You can have a one-person limited partnership, believe it or not, and a one-person LLC. So let's go through these together and talk about what stuff is set forth here. And then I want to add some more columns. The first thing he talks about here says sole proprietorship. Now, clearly, that's a misnomer. A sole proprietorship is one person, me having just said this whole story about one person. But the whole concept of this chapter in the book is, how do we get a bunch of people together to invest in a piece of property? Well, a bunch of people don't invest as a sole partnership. A sole partnership is one person. So what this first category means is individuals. The sole proprietorship. Change that to individuals as JTWROS or as tenants in common or whatever. But the point is, that's individuals. All right, now, the first thing we want to talk about is what type of liability do individuals have? This next column was liability. What type of liability do they have for this business venture? Now, to picture this simply, the type of liabilities we're talking about are really twofold. What if somebody gets hurt on the property and sues, and gets a judgment for a personal injury on your piece of property? Is there liability of the individual owners for that?
Yes.
And secondly, what about liability for debt? If the corporation, or for example, borrows a bunch of money, are the individual shareholders liable or not? Okay, that's the type of concepts we're talking about here. So, for individuals, liability is unlimited. If somebody gets hurt on a piece of property and sues any of you as individual owners, they can go after all of your own individual assets. If they get a $10 million judgment, it doesn't matter that they fell and got hurt on your crappy little $5,000 piece of property. They have $10 million worth of damages, they can sue you for $10 million and they can recover if you hold title individually. Likewise, if you were to pile up a whole bunch of debt, even though the property is only worth $10,000, well, you're liable for all the debt. That's what individual liability is all about, unlimited individual liability. Now, taxation, as I talked about, we're not going to focus on tax rates because this is not a tax course. But you just need to be aware of concepts that individuals, being taxed as an individual is a good thing because you're taxed only once as an individual. You're not going to be taxed twice at an entity level and then again at the individual level. And the number of investors, he of course here says 1 for sole proprietorship, but obviously we're talking about 2, 3, 4, 10 individuals here. Now, the next thing is a corporation. You're going to know it's a corporation if you see Inc. or Co. or Corp in the name. Florida requires you to have one of those words. there is limited liability in a corporation. The shareholders, the investors, are not liable for personal injury and are not liable for debts of the corporation, unless, of course, they happen to guarantee those debts. We'll talk about that subject differently when we talk about mortgages. But ordinarily, if the corporation goes out and borrows money and doesn't pay it back, the individual stockholders are not liable. That's a plus. That's limited liability. That's a good thing. But the downside in a corporation is double taxation. Corporation makes a profit, pays a tax on its profits, pays a corporate profits tax. Then it distributes the money to the individual shareholders, and they pay tax again at their individual rates. That's double taxation. So that's a negative. How many investors can you have in a corporation? Well, it's unlimited. General Motors, think about how many investors General Motors has. Unlimited. The next type thing we talk about is a subchapter S corporation. Now, like a corporation, subchapter S corporation has limited liabilities. The shareholders are not liable. But the benefit of an S corporation is profits are taxed only once. The income is passed through to the individual shareholders who report it on their return and pay tax at their own individual rate. But the limit on a sub-S corporation is there can only be 75 shareholders. Now that works just fine for 6 of us. Wouldn't work for General Motors. So in addition, all shareholders have to be individuals. So other partnerships and other corporations and other entities cannot be shareholders of an S corp. So there are some limitations on an S corp. A general partnership. A general partnership, just like individuals, has unlimited liability. That's bad. Anything bad that happens to a partnership, all of the partners are totally liable in unlimited amounts. There is no liability limit whatsoever. There's no liability shelter in a general partnership. Now, the benefit is partnership is profits are taxed only once, passed through the individual return. You can have unlimited number of partners in a partnership. A limited partnership is different. A limited partnership has limited liability for the investors. They are called limited partners. But there is one general partner in a partnership. That general partner does have unlimited liability. So you have to have one general partner who will be unlimited in liability. And that general partner usually ends up being a corporation that has no assets. So basically, it ain't liable either. So you get the good taxation as a partnership here, taxed only once. You can have an unlimited number of limited partners, those are your investors. And the last one is an LLC, limited liability company. Now, there is limited liability. The owners are not liable. Right next to where it says limited liability, and then it says owners, change that word to members, because the owners in a LLC are called members. There is partnership type taxation where taxation is not, there is no tax at the LLC level. There is only taxation at the individual level of the individual shareholders. And you can have an unlimited number of members. So the considered to be most beneficial way for people to own property today in a commercial venture is the LLC. But a lot of people still use limited partnerships. And if you use a limited partnership with a general partner that's a corporation that has no assets, really nobody's liable there either. You get the best of both worlds here of partnership type taxation, which is good taxation, which means no taxation of the entity, but limited liability. Now, The one additional thing I want you to be aware of, and make one more column. I was going to go through with you how you form these things in Florida, but I don't think it's worth doing. Whoever does your formation of your entities will do that for you in Florida, of how you form them, what you file on the records and off the records. Here's the one thing I want you to know and to list. I want you to add one more column to the right of each of these types of entities. And I want you to entitle this column what I call management authority. And that is who can bind the entity, who can sign for the entity and legally bind it. And the reason I want you to know this is because in your real estate business, you're going to be dealing with corporations and limited partnerships and LLCs. And you're going to try to get them to sign documents, contracts, notes, mortgages, agreements. You need to know who is a valid signature for these type of entities to know that you got the right person, because if you don't have the right person, your instrument is worthless. Whether it's a note, a mortgage, a deed, or whatever. Yes?
Can you find that information in Sunbiz?
Can
Or-
you find out who these people are?
Okay.
Yes, yes. I'm going to go through that with you, and you'll be able to look them up online and see who they are. But my point is, you can find out who the individuals are who I'm going to tell you about, but you're not going to know. But now you need to write down what title it is that you're looking for to deal with, is what I'm telling you. If you were dealing with a group of individuals who owned a piece of property, 2, 3, 4, 10, they all need to sign. That's one of the negatives of dealing with a bunch of individuals holding title. Every time you want to get a deed or a mortgage, they all have to sign. You got to find them all. In addition to, they die, they get divorced, they get tax liens. They all have to sign every single document when you all hold title together individually. If it's a corporation, the president or any vice president or the CEO has the authority in Florida to sign documents. The chairman of the board has zero authority. And a lot of people think that chairman of the board is this wonderful highfalutin title, and I guess it is, in an honorarium sense. But he has no corporate authority whatsoever. Can't sign contracts, can't sign deeds, can't sign checks, can't sign anything and bind the corporation. You want a president, vice president, or the CEO. With the subchapter S corporation, exactly the same, because it's simply a corporation. A subchapter S corporation is nothing but a corporation that's taxed like a partnership, but it is a corporation. So exactly the same. If it's a sub S, frankly, if it's a sub S corp, you're not even going to know it. A sub S corp looks just like a corp when you're dealing with them. They just file their tax return on a different form. So you treat them just like any other corporation, get president or vice president or CEO. Now, if you're dealing with a general partnership, any one general partner can bind the partnership. Any one general partner. Even if there are 10 general partners, any one can bind the partnership. General partner. If you're dealing with a limited partnership, only the general partner. There will only be one general partner. There will be hundreds, maybe, of limited partners, but there will only be one general partner. That's whose signature you need on a document, the general partner, when you're dealing with a limited partnership. When you're dealing with an LLC, you need the signature of either the manager or the managing member. Only those two titles work. And Laura is correct. As to each of these types of entities, you can go online with the Florida Secretary of State to Sunbiz and see every entity with one exception we're going to talk about in a minute. Every type entity has to file an annual report with the Secretary of State, and every year tell the Secretary of State who are our officers, who are our general partners, who are our managing members. So when you get the signature of one of these parties binding the entity, you go online and check and see, is that the right person? Joe Blow told me he was the president. Well, you go online and it was Sam Schmo. Well, what? You know, you probably got a problem here and you got the wrong officer. You need to know these, because getting a document signed by an entity by a person who doesn't have any authority is totally worthless. Not binding. Can't be enforced. If it can't be enforced, it's not worth having. Okay. That's the end of the chart. I want one more type entity I want you to be familiar with in Florida, and then we're done with this chapter. I'd like to finish the chapter, and then we'll take our lunch break. And that's a trust. A Florida land trust. Land trusts are big in Florida. They used to be even bigger. You may hear about these called an Illinois land trust. That's where they were started. Florida adopted them big. A trust is where title to a piece of land, or to any asset, but in our case a piece of land, is held by a trustee for the benefit of some beneficiaries. Just like any trust that you've heard of before, trust in estate planning, trust in bank accounts, there's a beneficiary who's the real owner, and there's a trustee who holds title of the asset for the benefit of these beneficiaries. In Florida, in the 60s and 70s, land trusts were everywhere. And banks were the trustees. And if you looked at all commercial properties all over the place, all you'd ever see was title to all pieces of property were held by a bank as trustee. You never knew who the real owner was. They held title as trustees for the individuals who were the real owners. And you couldn't find out in the public records who the real owners of property were. And the bank sure as hell wouldn't tell you. The banks were like Swiss banks that you hear about, where their secrecy is their motto, and they won't tell you nothing. Well, and understand some of the benefits of this. In the 60s and 70s, foreign investors were bringing money over here to Florida to invest, but it was violating the laws of their countries, and they weren't allowed to be taking currency out of their countries and investing in Florida. So they could invest in Florida with title held by a bank, and their home jurisdictions couldn't find out that they had invested money in Florida because titles were held by banks as trustees. Another example was when you're acquiring a parcel and putting a parcel together as a secret. When the whole Disney property was all assembled all around Orlando, they had trustees going around submitting offers on all this land. Before anybody found out Disney was involved, and Disney acquired all this acreage junk, property worth nothing. But if people had known this was being assembled as a parcel for Disneyland, Disney World, the prices would have gone nuts. But the point was it offered secrecy too. As a land trust, nobody knows who the real buyer is here. It's just a bank who could be representing anybody. Well, this all worked great until environmental liability came along. When we had Congress imposing environmental liability on title holders, and banks all of a sudden were becoming liable for environmental problems on properties that they owned as trustee for somebody else. But the EPA said, we don't care if you own for somebody else, you hold title, you clean it up, and you pay the fine. Instantly, all the banks quit being trustees. And then quickly, you couldn't find a bank that would be a trustee. But we still have individuals today holding title as trustees of property. So title to property can be held not only in any of these entities we talked about, but they can also be held in a trust. Therefore, the 6 of you could go out and form a land trust and appoint one of you also as a trustee, and all 6 of you would be beneficiaries. One of you would be trustee, and one of you would hold title of the property. The problem is, whoever is the trustee and holds title of the property, he's the one that gets sued. He's the one that gets sued when somebody gets hurt. He's the one who gets sued when there's an environmental problem. So it's a little bit risky being the title holder. And that's why banks quit doing it, and frankly, why individuals may want to quit doing it too. Okay,
Well, aren't there tax benefits?
I'm sorry?
Aren't there tax benefits to the beneficiaries for that?
Aren't there expenses to
Tax benefits. To
tax benefits to the trust?
To the beneficiaries of the trust.
They're taxed as a partnership, so it's not, it really doesn't change the same taxation that they would have if there were a partnership. They're taxed at their individual, the beneficiaries together as the beneficiaries of a land trust are treated as if they were partners in a partnership, even though they may not have a partnership agreement. And all of the profits get passed through to the individuals, and they pay the taxes at their own individual rates, just like a partner, limited partner would, or a general partner would. So it is a tax benefit in the sense of it's taxed the same as a partnership, which is good. But there is no tax. There is no tax at the trustee level. Okay. I'm sorry we had to work through that quickly, but I wanted to get through it, and it's a little bit beyond the scope of what we wanted to cover. Does anybody have any questions they want to ask now? And if you think of some more, we'll talk about them after lunch before we change gears. Yes, ma'am?
Did you go over liability as to trust? Like,
As liability as to trust, there is no liability shelter for the trustee. The trustee is liable. The beneficiaries are not liable. And that's why all the trustees who were liable wanted to quit being trustees. So there is total liability to the trustee. There is limited liability to the beneficiaries.
Can you give us an
And
example?
taxation would be the same as a partnership.
Can you give us an example when someone would take on that responsibility of being a trustee for the beneficiaries?
I'm sorry, what are the liabilities?
What's an example of someone taking on that responsibility as a trustee?
I've held title any number of times for the benefit of clients, where people didn't want to know who the title holder was. Clients that I trusted, that I knew would cover me.
Can you get that in writing? Can you get that
Well, what you do is you
legally binding?
prepare a trust agreement. You prepare
Okay.
a trust agreement that says, I'm gonna be the trustee, I'm gonna hold title for the benefit of all you guys. You guys will own and manage and operate the property, you'll receive all the profits, you'll receive all the income. My sole job is to hold title. And that means, of course, then that I'd have to sign mortgages, but you indemnify me. I'd have to sign leases. You sign leases and you collect the rents, but I'd have to sign deeds and mortgages as title holder. But y'all, as beneficiaries, would indemnify me. That's all under the trust agreement, and that's off the record. A deed simply would be a deed of this parcel to Steve as trustee for the Heisinger Group, and that's how title would be held. But you don't form an entity with the Secretary of State. You don't report anything through SunBiz, so the secrecy level is increased there because trusts don't have to report to anybody. A trust is not really an entity, and that's why we didn't discuss it in a list like these entities here. It's a vehicle of holding title, but it's not a legal entity. It doesn't get a federal tax ID number. It doesn't file a tax return, and it does not register with the Florida Secretary of State. Okie doke.
And that's the main purpose is just for secrecy.
The main purpose of what, I'm sorry?
The main purpose of the trust is for secrecy.
Yes, that would be, that's the greatest purpose that I can think of. A purpose of all of these, realize, is keep all the individuals from holding title. Okay? We said we don't want all the individuals holding title because of deaths, divorce, judgments, tax liens, bankruptcies, things like that. We want to keep the individuals out of holding title. Yeah, if the trustee is an individual and the trustee dies, you got a problem. You know, the trustee has a divorce or a bankruptcy or whatever, that can be a problem, but you don't pick somebody who's going to have financial problems to be your trustee. But you never know, your trustee can get run over this afternoon by a truck if it's an individual. But in your trust agreement, you appoint a successor trustee that says if something happens to my trustee, here's who steps in to serve as the next trustee. as a success, it's called a successor trustee.
Okay.
Yes, ma'am?
You keep saying, if the trustee is an individual, so is there an option for it to be a company, an entity?
There's an interesting history on that. For years, corporations in Florida were not allowed to be trustees of land trusts because the banks wanted it that way, because the banks wanted all the business so that the banks could be trustees of all the land trusts. Therefore, a regular Florida corporation that did not have a trustee license as a trust company could not be a title holder as a trustee. And the banks wanted it that way to keep all the business so they can have all these land trusts. And of course, banks were in big fees as these trustees of these trusts. Then all the banks quit being trustees. And the legislature amended the law about 15 years ago and said, okay, corporations can now be trustees even if they're not licensed trust companies. They don't have to be banks or trust companies. So you could use a corporation as a trustee of a trust, just like you could use an individual. Used to be you could only use a bank as a type, because a bank is a corporation. Used to be you could only use a bank. Now you can use an individual, you can use a corporation, and a corporation solves those problems, at least if a corporation doesn't get run over by a truck and a corporation doesn't die and doesn't have a divorce. It can still have financial problems, but it solves some of those problems that an individual can have if you have an individual as your trustee. Okay, doke? We good? Everybody want to quit? Let's do lunch. Let's start at 20 after 1. See y'all then.
You guys all just going to Einstein or?
Yeah.